This is our Forex blog for September 27th, 2013, and one of the easiest ways of trading is to use our currency indexes. This shows you what each individual currency is doing. Here's a chart of just the dollar, of just the euro, yen, and pound. And obviously it doesn't take a rocket scientist to know that in order to have the strongest trends, you want one currency that's explosively up and the other one that's extremely weak. And so basically, in a nutshell, you can see the euro went from below to above its hourly moving average right around here, and it trended up for hours. At 3 o'clock, what was one of the weaker ones? The dollar was underneath its hourly moving average. However, it was pretty far down near its lows. The yen is just kind of going sideways. The pound's very strong, so you wouldn't want to trade the euro versus the pound. We can look at some of the other currencies and find one that's just about going weak at 3 o'clock. Here's one, the Australian. It's underneath its hourly moving average. It's coming back up to its previous day's low. It's a good ways away from its lower band. And so at 3 o'clock, if you are trying to play the probabilities, which that's all trading is, you're not going to have 100% winning trades, but if you take trades that are likely to work, probably 70-80% likely to work, and also likely to give you 20 to 50 pip wins, you're going to have some losing trades of 5 to 7 pips, but you're also going to catch a slew of 20 to 50 pip wins, which is going to eat them up. So remember, the euro broke out from below to above its hourly around 3. The Australian was weak, and it had a little bit of a pullback off the lows, right at a major resistance area, the hourly moving average, previous day's low. This is a perfectly ripe trade right here. And so you got the nice breakout right here at 3, and obviously this is an unbelievable trade. Most of them are only going to go 15 to 25 pips your way. This one went 75, 125 pips your way. And you might have got out of your trade right here not expecting any more. But even in the worst case scenario, getting out too soon on this trade, there's always that trade every week that you kick yourself. You make 15 to 25 pips and it goes 100 pips. Happens to me almost every week. I hate it. But anytime you take a trade where it's likely to give you 2 to 3 times more profit than what your risk is, you're doing something right. And our currency index allows you to do that. Since these all have the green color chart on here, if I click this button right here, when I scroll one of them back, they all go back at the same time. So you can see that Australian was very ripe to go down at 3. Now, what is another strong one at 3? Well, the New Zealand's already been strong for an hour, so you don't want to kind of get into a trade after it's already run a good distance. That's why the euro is a better bet. The euro coming up to 3, and it's a little bit after 3 actually, so let's go bring that chart back up and be a little bit more accurate in our description here. It's a little bit after 3. It's probably somewhere with a breakout right here. It still made an absolutely phenomenal move up, but even if you took that trade and put your stop right underneath that bar's low, you still have 1.5 times profit minimum. Most of the time I get out of a part of my trade and then let the rest run. And one easy way to catch as many pips as possible is every time it makes a higher high and pulls back, you move your stop up. Higher high and pulls back, move your stop up. Higher high moves back, pulls your stop up. Higher high pulls back, move your stop up. Higher high pulls back, move your stop up. Slightly higher high pulls back, move your stop up. Does not make a higher high here and you get stopped out. So you definitely want to employ a strategy like that for at least half of your position. Typically I'll get out of half my trade when it kind of pulls back, because most trades, the vast majority of trades don't go 100 plus pips your way, or else we'd all be billionaires. So that just does not happen. It's unrealistic to expect every trade to be this phenomenal. Here's one of the things that I look for in a currency meter. A very strong trend up, and anytime a currency goes above its upper containment band, it's very likely to pull back. But after that pullback, it's likely to resume its trend, because most currencies do not go outside of their 2.0 bands. This might happen maybe once or twice a week per currency. Typically when they go underneath there, you get a little bit of a bounce. hits it, bounce, hits it, bounce. This is much more likely to happen than a currency going beyond it. Currencies that go beyond it tend to oftentimes have deeper pullbacks. However, when it finds support, like at the hourly moving average right here at 5, the pound's very strong. The daily trend's up, the weekly trend's up, the monthly trend's up. You want to trade this versus a currency that's weak. And you can clearly see the dollar's been weak all day. 5 o'clock, it's right at its hourly moving average. It had a 2-hour pullback up, while this one had a multi-hour pullback down. It's a pretty high probability trade. Doesn't mean it's going to work, but the odds are in your favor. You get a weak dollar, strong pound, and they both had a pullback at the same time. So I don't know what else to say other than, the timing ability of our currency indexes is phenomenal. As you can see right here at 5 o'clock, the pound was very strong and pulled back and was likely to go up at 5 because it was right at its hourly moving average, which you can still see right here. The dollar was weak and it had a pullback up to its hourly moving average. Very high probability resistance area, and it's likely to go down. This is across all the dollar pairs, not just the euro dollar. It encompasses the euro dollar, pound dollar, Australian dollar, New Zealand dollar, dollar Swiss, dollar yen, and dollar CAD. So amongst all those pairs, the dollar's been going up, and this is hourly moving average of the index of all those pairs. So instead of watching 28 charts to kind of get a feel for what every currency is doing, you only have to watch, to get a feel for what the dollar's doing, you'd have to watch 12 or 13 charts. Now you can just watch one. With our currency meters and what I prefer, the perfect oscillator, you can time it even better. But here's 5 o'clock where you're looking for a buy. You don't get in at 5. You're just expecting a reversal. You draw a trend line over those bars high, and maybe 5 minutes later you get in with your stop underneath here. And again, this one didn't take off immediately. It kind of went a little bit your way, pull back, your stop, you move up to here, makes a higher high, pulls back. Typically at that point, I'll draw my fibs on this, and you get your fib targets up. I'll exit half the trade here, and probably the second half right here. I would have got out of that trade. It pulled back and went sideways. Got a nice little sideways rectangle breakout here, another pullback here. These are basically the entries that I would have taken. Whoops. Right here. I might have been out of that trade here, depending on my mode for the day. If I'm trying to work on a software, I will take more scalping trades and be out and have to get back in. These are the entries that I would do most days. All right, well, I promised the trader that I would show longer term methods as well as short term methods. These currency indexes are on a 5-minute chart, but you can just as likely show them on any other chart you want. Let's say you want to see the euro. Put star EUR, and you can put in a 60-minute, 30-minute, 15-minute, 25 minutes, whatever odd number, or whatever you want. Hit OK, and this is going to show you the hourly trend of the euro. And what's nice about this is it'll let you see back farther. Let's go back maybe 20 days. And you can clearly see the euro's up. It made a higher high today than it did the previous day. And you also can see kind of trend line breaks on this. Trend was up, pulled back, kind of going sideways, had a false breakout underneath this low, and then back above it. Typically you can, anytime there's a false breakout, you can buy the second it goes back above the previous swing low. So you can get into a trade right here, in this case only a few pips above the trend line, or below the trend line. But absolutely explosive move up. So you can see, on the dollar chart, explosive move down last week, kind of a pullback. You can see probably a fib target off of this move, very close to 1, and it's clearly making, lower lows or lower highs up here. And as this pulls back up here today, the dollar's not likely to be explosively strong. So when you had this breakout in the euro, very high, you can use any time frame chart for the entry. Typically you want to use a smaller time frame chart than whatever the currency indexes you're using. But you're expecting a euro dollar breakout to the upside. So you might have bought this little breakout, didn't really pan out, bought this little pullback, and then eventually took off. And the currency indexes show that the euro was going up against all pairs, and the dollar's kind of going slowly sideways to down. It didn't fall like a rock, or else you would have caught 100 plus pips. Let's show these on longer time frame charts. Put in period D for daily. And you can clearly see the euro is just super strong, and the dollar's been recently made a lower low than it did in the middle of last year. So the dollar is just astronomically weak, and the euros are up near its highs. Let's try to find some other pairs longer term. Swiss. It's strong too. So that means you could be looking and focusing on sells in the dollar Swiss. And so when you see this currency going sideways and breaking out through its lows, you can go short right here, a little bit of a pullback. And guess what? Astronomically, for the dollar Swiss at least, nice 50 pip drop. And that's how you use the currency indexes. It doesn't take a rocket scientist. You can use it on all time frames. The methods are very simple. You find a strong currency and you buy it versus a weak. Or if the top currency is the one that's weak and the bottom one that's strong, then you sell it. And basically you're looking for higher highs and higher lows for an uptrend. Higher highs, higher lows in here, higher highs, higher lows, right? Higher highs, pretty much similar lows. Went sideways for, in this case, a couple days, and so it's very likely to resume its uptrend. If you look at a daily chart of the dollar Swiss, more than likely it was going sideways and then broke down a few days ago. There we go, and you can see that on the chart. Broke down underneath 9100. And the low was 90.22. It was almost an 80 pip drop. So whether you're a short-term trader, scalper, or what I typically try to do is trade for 30 minutes to 3 hours and look for 15 to 50 pips. It doesn't matter what your style is. You can adapt our tools to fit your needs. If you're a longer-term trader that has a full-time job or business, you don't have time to watch it tick by tick. You might want to have 15 to 20 pip stops, shooting for 50 to 200 pips moves, and you can do that using our tools. And I've only showed one of them. The containment bands work on multiple time frames. Range charts work on multiple time frames. The perfect oscillator works on multiple time frames. The range projection tool works excellent on multiple time frames. It's very easy in less than an hour to adapt our methods to any other style.